Joining us right now is Joao Gomes, professor of finance at the Wharton School. You think we have a real big problem ahead, and I'm not disagreeing with you, but just lay out how bad the problem is and how quickly it becomes a problem.
Good morning, Andrew. How quickly is hard to say, but I think that there's real urgency, and I think people are not really appreciating that. I think real interest rates are high, and they're going to, and this is a sort of a momentous change relative to the last 15, 20 years. I think all the trends that I see on real interest rates point towards higher rates. It is true, growth rates are a little higher. We'll see how long that lasts. That's the one thing that that is a positive the last 2 or 3 years. Some of that is demographics, immigration, and so on. But real interest rates are significantly higher. And I think all the projections that you see, everything you see, is very benign. It forgets that interest rates are high. It forgets that the 2017 tax cuts are set to expire in 2025. It forgets that capital inflows are going to be reduced and are already significantly reduced. So a lot more of the debt is going to have to be funded internally. These projections, basically, if you're wrong because you're too pessimistic, if you sort of, if productivity turns out to be a little better than you expect, it still doesn't change the trend. But if it turns out to be a lot worse than you expect, or even a little worse than you expect, you go to 200% debt to GDP ratio in 30 years. What really added urgency to me is I think we'll have a serious debate next year about the tax cuts and whether to extend them or not. And I think we just can't afford them, honestly.
You think we can't afford them?
I don't think we can. I know, Joe might not like me to say this, but I just don't think we can afford them.
You know what's going up, Professor, is in a emergency,
mandatory.
But in a non-pandemic, non-emergency situation, so spending's going up too. We're right where
I agree.
We're right where we were in terms of what we needed to spend during an emergency situation, and as it always happens with the government, we're not going back down to pre-pandemic levels. We're staying where we are and going up. So I understand what you're saying about the tax cut, but that just letting those things expire isn't going to solve anything. We need to address spending across the board.
100% agree with you. 100% agree with you. I would only say, and I don't know if it's worth debating this here, a lot of that is some of those things have expired. It's just that some of these mandatory programs that we have, some of these entitlements have, they've just continued to grow. So overall spending is about the same level, but largely there's been a little bit of a composition change.
Part of it.
I agree. That is.
But can we just talk about the potential for a crisis? And the reason I mentioned a crisis, the timing. And I know you said it's hard to predict a crisis and when that's going to happen. But let's talk about it, because unfortunately, our form of government, for better or worse, doesn't seem to operate unless there is a crisis and the clock is about to hit midnight and something terrible is about to happen on the other side of it.
Yeah.
So,
well, I think to me an eye-opening experience, and I've been talking about these things forever, but I never thought it was as urgent as right now. I think an eye-opening experience was definitely what happened in the UK in 2022. That's one episode where a government that sits, I think, financially better position than we are now, just loses confidence of the bond market just like this, right, in the space of a few days. That's something that could definitely happen to us next year, right? We announce a fiscal path that is just, markets just wake up to it and they say it's unsustainable. That could happen.
We've been crying wolf, or at least it looks like we've been crying wolf, and it hasn't happened. Yeah. That's a very bad lesson to learn. And that's where MMT comes from, and that's where, well, we've got the reserve currency, we can do whatever we want. And now we spent a lot of money in the economy. Look, the GDP's great, unemployment. These are bad lessons to learn when they can come home to roost very quickly. And you're right, the rug could get pulled right out from underneath the bond market probably when you got this much supply. Really? Well, and you're at Wharton. You may know what you're talking about.
So we want to
a little bit. I know a little bit.
A lot of these stocks have gotten a little ahead of themselves on what will turn out to be false hopes.
So we're in this moment right now, and we've been in this moment for a little while, where we're back to higher interest rates on, let's say, the 2-year, the 10-year, negative for a certain type of stock, big stocks, important stocks. But then when those rate fears ease for the day, it's like a green light to go out and buy them. It's very reminiscent, Judge, and you'll probably remember this, of the risk-on, risk-off stuff from 2011, 2012, when on a Monday it would look like Europe is Armageddon, and then the next day European currencies would rally, and there would be this like whole group of stocks you could just blindfold yourself and buy any of them. We're doing that now with interest rates, and it's fun. It's interesting. Eventually, everyone learns the game and it stops working. But look at today. You get the rate fears cooled off a little bit. What are your top 3 leadership groups? Surprise to surprise. Real estate number 1, up 1% on the day. Consumer discretionary number 2, up almost 1%. Number 3 is industrials. Number 4 is tech. It's like surprise, surprise. So today
Russell.
So here's what I want to do. I want to coin the term. We're going to call it cut on, cut off. Today is a cut-on day, right? You got a little bit of easing in rates. People are a little bit more sanguine about, what's happening with the inflation story, and they'll let these stocks run. If you get something that seems to be negative on the inflation front, or tomorrow's jobs report is a blowout number, or average hourly earnings are way ahead of schedule, you're going to see it be a cut-off market. And you're going to see industrials down big. They'll crush the real estate names. They'll hit consumer discretion. So this is the new game. I hope you all learn it. I hope we can have this game for, I don't know, as many weeks as we have until June, July, and then eventually it'll end. But that's what's happening right now. And you could track it yourself on your screen.
So if it's that binary,
cut on today,
as you suggest, right? Rates up and, cut off, rates down.
Yeah.
Cut on. So, Liz, do you feel like we are vulnerable? Whether it's Kerry expressing it through selling or trimming, some names that have gone up a lot on these hopes. Josh laid it out pretty well. The market is obviously super sensitive at this moment about higher interest rates because it's traded a little uneasy as rates have backed up. Well, they're back off, and here we are green again.
Yep, and if you look at something like the MOVE index, which is the volatility in yields, that's gone up quite a bit this week. And even though we have a little bit of a back off in yields today, we're still up 15 basis points in the 10-year this week. That is a huge move in Treasury yields. So far, it's been a short-term change in trend, meaning yields up, stocks down. That's the change in trend. The year-to-date period saw yields up, stocks up. So I don't think it's definitive yet that that's what's occurring, but I do think that the market is going to run out of patience for this waiting period. We somehow digested going from 6 cuts to 3 cuts very easily, and at some point we continue to keep pushing these back. I think really the bigger risk, what we are at risk for, is a reheating and a reacceleration in inflation that extends beyond the February numbers because those were explained away by seasonality. If we get hotter inflation for March, we get hotter inflation for April, I think you're going to start to hear conversations about actually hikes coming back into play, and that will make people very nervous.
That would be super cut off.
That way cut off.
Look, you've just talked about, it was weeks and weeks ago, about the biggest risk you see is the possibility that we do have reigniting inflation more sticky than people think, and then the Fed's got to either act on that or just keep rates much higher for much longer than even people suggest.
That is the risk, and I think if you listen to what the Fed had to say the last time they had the presser, they were basically like, look, a strong labor market alone in and of itself is not going to interfere with us doing what we think we need to do on the interest rate side. I don't think the market believes them, quite frankly. So I would be looking to tomorrow, and don't worry about headline. So we're looking for 216,000 jobs. Don't worry so much about that, because if that's at 300,000, no one's going to fall out of a window. Look at average hourly earnings. Look at hours worked. Like, look at the stuff that's really going to filter into PCE in the near term. That's the stuff where the market really might not like it, to Liz's point. She's exactly right. And I remain of the thinking earnings are not the risk. It just isn't. International stuff is not the risk. This is the risk that the Fed says, you know what? One more wouldn't kill anyone. And we're back to talking about when is the next 25 basis point hike. I don't think we're there yet. I just think if you want to worry about something, that's the thing you should worry about.
So how should we view the markets here?
Well, as Josh has said, tomorrow is big for near-term trading. But one thing I like, what I've seen within the CME Group's Fed Watch tool, is you have a 55 to 60% probability of 3 cuts this year. So it's not like it's really fully priced in. So the market is being prepared for some hotter data. Now, in the last couple of days, against your point, and the cut on as jobless claims a little higher than expected, services data a little lower than expected. But with all of this happening, CPI and PPI have started to nudge up a bit. And I look at 3 being a trend. trend. We've only had 2. So I think the next couple of weeks here are going to be absolutely crucial for this market.
We want to bring in Ashish Shah. He is Chief Investment Officer of Public Investing at Goldman Sachs Asset Management. And Ashish, a lot of people look around at the markets right now, and even though we've been at or near all-time highs, there is some concern, and that concern plays out in the Treasury markets. What do you think right now? How do things look?
So first of all, we think the market here has runway. We like risk assets in general, but without question, there's been crowding and momentum going on within the market that is real cause for concern, particularly if the Fed ends up staying higher for longer.
What do you mean crowding and momentum?
So, we've seen momentum stocks do better than they have for really 15, 17 years, going back to periods of time that really should concern us. And so, that's the kind of environment where you ask the question of what can I do to prevent myself from being exposed to a drawdown, a sell-off in the market that's sharp and violent. And, I think a lot of investors are worried because the money's been really easy to make over the course of the last 6 months. You've seen kind of the AI rally that's been, fantastic, and it's generated a lot of return. And AI is a fantastic long-term trend, but there's going to be crowding when popular trades kind of get rinsed.
So what's the answer to that question? What can you do to protect yourself?
We think that there are a couple things going on, and they're already starting to take place within the marketplace, which is investors are looking for diversification and other themes to play that are long-term themes, but still represent value within the marketplace. So I think within the U.S., we're seeing kind of a broadening of the themes that we're seeing, particularly around industrials, right? So people are asking, if there's going to be this AI build out, how do I play it through the industrial space? Is it data centers? Is it literally, steel or electricity to power the data centers? I think when you look more globally, what we're seeing is actually that you look to Asia, places like Japan, like India, and you're seeing real long-term stories that are driven by structural trades within the market, where companies are improving their governance, and that's unlocking a lot of value. I mean, India could end up being a decade of growth that really kind of propels the economy, and there's going to be all sorts of plays from consumer to infrastructure within that. You don't just have to bet on AI.
Do you think some of those markets, like in India or Japan, are a better place to invest than here in the United States?
I think that they're equally good. Like the U.S. is beachfront property without question, right? Like we have the density of talent and resources within this country to really drive forward, this next generation of technology. But there's, you look at U.S. stocks and they've gotten expensive, right, by most measures at the top line. Now, within the market, there's kind of the normally priced stocks, but then there are stocks that are doing really well as a function of AI, and that's where the risk return is changing. I think when it comes to the bond market, right, again, you have real rates that are very high because of this growth. The Fed's, been hiking, they're now looking at pivoting, and that may end up resulting in kind of an opportunity to, again, diversify, particularly if growth slows.
I know you were sort of listening to our last guest. He had some concerns about the idea that buyers for U.S. Treasuries could disappear or go on strike at some point if they don't like what they see in future budgetary lines and the direction we're headed on things. Ray Dalio was speaking just yesterday and saying that he's concerned. He thinks there's a 50-50 chance that there's some sort of a civil war or civil break in the United States where the states can't get along and no longer agree to abide by federal laws that exist. Those are some pretty dark doomsday type scenarios. Yeah. Do you worry about any of those things?
Look, I think when you're a long-term thinker and a long-term investor, all you do is worry, right? But the question is, what do you do about it? Because you're sitting in cash is a long-term losing game.
Yeah, right.
And so I think the first thing you have to do is ask yourself, are there things of value here in the U.S. that, regardless of where you sit, are going to continue to be valuable and grow in value over time? And I think without question, the U.S. has a lot of assets that pair with those liabilities, that debt, that are going to actually, guide us through the next periods of time. But there have been times when the dollar has been weak, and right now we're at a point where the dollar is strong. And so it makes a lot of sense to look outside the U.S. for growth stories, for long-term growth stories where you can generate returns. But, look, the rule of law in the U.S. is why the U.S. is actually so powerful. The fact
I think that's what Dalio's point was. Rule of law may not continue to exist if you see states ignoring federal mandates that are there, federal mandates completely disregarding what states think about some of these things.
Look, you go back to the history of the U.S. States and the federal government had fought for a long period of time. It's one of the fantastic things about our system of government is that our government actually competes, right? And that creates an environment where, ideally, investors and entrepreneurs can build businesses and do it in an environment where there's not going to be 100% certainty. But you look back at the last 100 years of this country, when has there been actual full certainty? Right? I think we're being a little bit spoiled.
There never is. You're right.
Yeah. But it's a real reason to be concerned and to make sure you're voting and being vocal when it comes to policy.
You say that if investors have been waiting for a signal to extend their duration in treasuries or in bonds overall, maybe it's too late.
So I want to take everyone back to October when we hit 5%, right? Everyone at that point was talking about how there was going to be no demand for treasuries and the U.S. government had to issue so much. And then we had over 100 basis point rally in the 10-year note. And the reason for that is because when you see that pivot, right, everyone's going to come out. And so trying to time it perfectly is going to be an impossible task because you see growth slow and the Fed has a lot of room to cut here. But we don't know when that's going to happen. All the talking heads, anyone that is, at the Fed, they're dealing with uncertainty. And so the reality is, if you're an investor, if you're trying to build a portfolio, you want to buy enough bonds that you're not going to be regretting not locking in that long-term yield.
Let's talk about streaming, continue the long conversation we've had. I remember, I think, in fact, when you first introduced it, we did our interview.
2017. No, 2000. I think 17.
17 or 18? $6.99. I remember
a long time ago.
Yeah. The price point was a long time ago, too. But, you cut the losses dramatically in the last quarter. You mentioned the stock moving, of course. In part, I think a lot of it moved on that idea that, this business is going to be profitable, and it really will be. You've been talking about it becoming a growth business. You haven't really given specifics on what your expectations are on margins. But I am curious, at this point now, you mentioned some positive things a month ago at a Morgan Stanley conference. What can you tell us in terms of how things are shaping up for the direct-to-consumer business, which is such an important component of investors' view of the company?
It is. Maybe I can provide a little bit more specificity. First of all, we've done really well in terms of streaming in the sense that we launched Disney Plus only in 2019, so it's just over 4 years ago. In a very, very short period of time, we find ourselves second to Netflix in terms of global subscribers for a pure streaming business. We know that we ended up losing a lot of money on that, more so than we expected initially. Part of that was because we were chasing sub growth and not as focused as we needed to be on the bottom line. I came back, the losses were around $4 billion a year. It was clear that that was not sustainable and not acceptable. And the goal was, first, let's reduce those losses. And as we've said, we're going to be profitable in our fiscal fourth quarter this year. We lost, I think, $130 some odd million in the last quarter. That's a huge, huge improvement. And we know exactly how we delivered that improvement. Now what we have to do is turn it not just into a profitable business, into a growth business. A business that has margins that this company and our shareholders would really be proud of.
Double-digit margins then, right?
Eventually, yes, double-digit margins, of course. The way to do that is actually very, very clear to us. It's very, very clear that we need more engagement in terms of consumers spending time on the platform. We just launched, which is a very compelling product, which is Hulu on Disney Plus, that came out of beta last Friday, actually.
Right.
And I can tell you that it is doing extremely well. We'll have more to say about that in our next earnings call. But we feel great about the engagement of those Disney subs who are not getting Hulu, who are now watching more programs that were on Hulu, including Shogun, as a for instance, which is a great hit. So we have to increase engagement. We need the technological tools to lower churn, create more stickiness. It's things like recommendation engines, getting to know our customers better. We need to reduce the cost of marketing. We need to reduce the cost of customer acquisition to get the margins up, obviously. I think we have to program more smartly, particularly outside the United States, which is to pick the markets where we could really move the needle and program with really strong local programming. We've had some success there. We need more success. Password sharing is something else. In June, we'll be launching our first real foray into password sharing.
You will.
Just a few countries and a few markets, but then it will grow significantly with a full rollout in September.
Cracking down on password sharing, essentially.
Yes, and all of that, obviously, all the things that I mentioned are components of what will turn this business into a business that we're.
Well, you sound like
really
you're describing what Netflix already is. I mean, do you ever get to a point where you can actually have margins that Netflix has?
Well, I think it would be a little premature for me to say yes to that. You know, it would certainly be great if we could. We aim, as I said, for this business to be a growth business for the company with margins that our shareholders will feel good about. We know how to run businesses well, high margin businesses. Parks and Resorts, a great example of that, as a for instance. I'm confident that we're on the right path, but we still have a lot of execution.
You want to clearly be the clear number 2, though, to Netflix. And, I mean, you already are. You probably don't even like to hear me say number 2. I know you, but that's what you are. And that wouldn't be a bad place to be. That
would be fine, but I think I wouldn't say that's necessarily the goal. But look, Netflix is the gold standard in streaming. They've done a phenomenal job in a lot of different directions.
Yeah.
And I actually have very, very high regard for what they've accomplished. If we can only accomplish what they've accomplished, that would be great.
I guess what I mentioned.
What the good news here is we know what we have to do. And look, we start with a very strong hand. Obviously, we've talked about it for years, but Pixar and Marvel and Lucasfilm and Disney and the array of content that we have. The acquisition of 20th Century Fox looms large in this process because we get control of Hulu. We get significantly more content, including Family Guy and The Simpsons and Avatar, and I could go on and on. We get great talent that came with it as well, and a global footprint that is, broader and deeper in a number of markets. So I think we have the goods, and now we've got to execute.
I mentioned 2 in part, and I think of Apple and Amazon separately. What I wonder is, do you think the other streamers can effectively compete? Does there need to be more scale in general? Would it help you if, in fact, there was more consolidation among some of the competitors?
I don't know if it would help. I think we know what you need to be successful in streaming, and not everybody has that. And I'm not sure everybody can get it. We know that we can, given everything that I've discussed, given what, obviously the content that we have and the technology that we're building and the brands that we have. I don't think everybody does, though. I think there's got to be some consolidation.
The bull market. Is it at risk? Let's ask NFJ's John Mowrey. He's the chief investment officer there. He was one of the first to say last fall it was time to buy stocks. He was right. He's with me here at Post 9. I've got Mike Santoli here on the desk, too. We might as well widen it out because I want to get to the bottom of what's taking place into this final stretch, because now the Dow's at the lows of the session, down by more than 400 points. It's about a 425-point loss. I said to you when you sat down, you get nervous because you were bullish before most. Now we're questioning where we are.
Good to see you, Scott. I'm not getting nervous, but I do like a different group of stocks today than I did a year and a half ago. Maybe I'll first start with the first quarter. One of the factors that really drove returns in the first quarter was price momentum. In fact, if you go back to 2000 and look at quarterly observations of that factor, you're in the 97th percentile of observations. Historically, when you get into those percentiles at that ranking, you should expect a reversal. So I do think that there is room for stocks to pull back, particularly those with the best momentum. Where I think more interesting opportunities lie are in some of the traditional value areas as well as small caps and mid caps.
Yeah, Mike Santoli, I mean, you're getting, I think, a real time and real world view, if you will, how jittery the market is to any major developments relative to geopolitics. That area of the world obviously is already on edge, so we're watching that. You know, oil moving higher is not great for the bull story about where inflation is going. It ratchets up sort of concerns overall. We make that move in the VIX too.
Well, a lot of things came together around 2 p.m. Eastern time, one of which was Biden tells Netanyahu he wants a ceasefire right now. Another one was Kashkari of the Fed saying maybe we don't get any rate cuts at all because if inflation keeps bumping sideways. All of it happened at once. I look at yields plunging and oil up and the VIX where it is and say this ain't about Kashkari saying we might be on hold on rates.
That's exactly right. I agree with that.
That's sort of if you want to just triangulate. But what was the setting for all of this? Which is, you mentioned the market's jittery. The market hasn't had a care in the world for months. And so it's been very calm and placid and just rotating and been able to be perfectly cooling off sideways. And I think you just got a little slippage in that rotation. The gears are slipping a little bit for now. The S&P 500 is basically back to a level it first got to about March 8th, so the beginning of March. We've been kind of playing around these areas where we first got to from the March Fed meeting 2 weeks ago. None of this is a reversal of trend. None of this is anything but kind of frictional action because of this little jolt of uncertainty in a very certain, self-satisfied, agreed-upon, happy market.
But this has always remained kind of this outlier risk that, the market for the most part, Mike, has looked past, and that being geopolitics and more escalation in an already tense area of the world. Especially coming now when you've had a bit of a backup in rates. Now, I know a flight to safety. You see what's happened with the yen, and you see what's happening here with bonds getting a bid and rates going down. But the market hasn't really fixated on what's been taking place in the Middle East. It's looked past it.
It has. And honestly, if you had to kind of give your preferences for why the market has an intraday reversal, you'd almost prefer it would be one of these like, oh, we're clenching up because of a what-if geopolitical scenario, because usually those are fleeting and usually those aren't, the major trend changers. But yeah, you're absolutely right. I do think that there's been enough of a kind of, incremental tensions raised, Israel, Iran. I don't want to speculate on the scenarios.
Sure.
It just shows you at a moment when a lot of people feel like the market maybe deserves to back off for some reason or other, at a market when momentum has been carrying the day, when we do have some jitteriness just ahead of the jobs number. I mean, that's coming on Friday, too, and there's two-way potential swings on that one. I think that explains part of how we just reacted to some of these headlines
For
today.
certain, I can tell you. I mean,
by the way, it's also tax time. You're going to find, I always say, it's Murder on the Orient Express. Everyone did it.